Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, great to see you there. Now, obviously, more and more talk coming out of these OPEC nations, all in a bid to jawbone that oil price higher, although we have seen it coming off in the latest session. How much further, can they, or how much longer can they continue jawboning before we actually see a change in those underlying fundamentals?
Yeah, I love how you phrase that. And I do think it can last for a long time. That's the story we've heard for a very long time, where oil will continue to shoot both on the upside and the downside. Let's bear in mind that we started the month of August with oil trading right around $40 a barrel, rallied $9 only to lose about half of that towards the month end. All of it really on talk, because the inventory reports come out, they say one thing, the market does another thing. Right now, it all is on just speculation, definitely not on fundamentals, and waiting for the next forum that's going to take place at the end of September.
Now, those comments that we were just going through there from the Saudi Arabian energy minister signalling that they won't flood an oversupplied market if there is no demand for it, isn't that what we are seeing them doing at the moment? Because all of the data that we see coming through, not only from Saudi Arabia, but the likes of Iran, I mean, they're continuing to flood the market at these record levels of production. And I don't know if that's sort of being met with the increase in demand there. What are your thoughts on that?
Yeah, no, it's very interesting. They continue to flood the market. Any kind of talk of freezing or just cutting back on production, that's really all they can do. They're running full tilt as we speak. One thing, though, that we have to keep in mind, that there were two major outages this month that were reversed, and that helped flood the market, giving traders a sense that they're flooding the market more than they actually are. I mean, it's basically playing catch up. So it's going to be very interesting to see. And we do have to remember that a market that even becomes balanced, which I think it will happen towards the end of this year, doesn't mean the market's going to go down. I still maintain my call of the mid-40s for WTI at the end of this year.
Yeah, and again, the latest data that we saw today in terms of those crude inventories, that was another sign that we are seeing this oversupplied market, because those stockpiles climbing more than projected there. The market certainly did react. That looked like it was a pretty bearish report.
Yeah, exactly. Fundamentally, it was a bearish report, but I have to say that this is probably the first time we've followed a report to a T, because there's been so many reports where product demand has been bullish, yet gasoline goes down, crude inventories actually go down, the market goes up, et cetera. There seems to be no rhyme or reason to each report, and I think it's word to the wise that we shouldn't follow each report, meaning oil is following that to the T, but it clearly is not.
Now, a lot of the moves that we are obviously watching in oil at the moment is also coming down to the US dollar. It's all those other factors that we've just spoken about, but the strength in the greenback is certainly putting pressure broadly on commodities and of course, those oil prices. A lot of what happens next in terms of where the US dollar moves will come down to Friday's jobs report, won't it? Because that is so crucial for the market, and then the timing of the Fed's next rate hike. What is the market actually looking for in those jobs numbers on Friday?
Well, I think they're looking, consensus is looking for the unemployment rate to drop to 4.8. The ads about 188,000. That's down from last month. But if you look at the 3-month average, about 175 to 200, that's what the market's looking for. And, it needs to be grossly different than that one way or the other to change the averages to have the Fed act. I mean, we have to remember that the FOMC basically is handcuffed to what's going on in Europe right now and the Bank of Japan. So as much as they can and should raise rates, they're probably going to wait until December, only because the sovereign yields just can't go any higher right now.
It is going to be very interesting to watch that report in terms of, the Fed's next move, because I think their meeting is happening only 3 weeks later, that September meeting. There's a number of other events to be watching, though. We have the G20 meeting, which, of course, is coming up this weekend. there's so much else sort of going forward to be sort of potential catalysts. So the market really not short of any market moving catalysts at the moment going forward, is it?
No, not at all. I mean, and you're right. There's a lot going on between the G20 meeting coming up, and then we also have ECB. We have the Bank of Japan at the end of the month. Also, FOMC decision on the 21st. So, yeah, there's a lot at stake. We're coming out of a period, or at least people think we're coming out of a period where we're just continuing not to see inflation. Global equity valuations are not compelling. We see earnings growth is non-existent. So we're in a real twilight zone, as it were, because people continue to believe that this low yield environment is good for the stock market. And mathematically, that is true, and that has been the case for a while. But we're getting to a point now where there's been no inflation. Productivity is just non-existent, as it were. And so it's going to be very fascinating to see what happens between now and the end of the year, especially given what's at stake in September.
Absolutely. All right, Larry, we'll leave it there. Really appreciate you joining us as always. Thank you so much.
Thank you.